Greetings, everyone. Welcome to our Beverly Hills Bar Association program and Beverly Hills Chamber of Commerce program, PPP Loan Program Round 2. And this will talk about what you do with the consequences. This will cover tax issues, audit and enforcement issues, as well as very important corporate issues. So we are delighted that you are joining us. Before we get started, a couple of quick notes. First, want to make a nod to comments on our membership. Just wanted to point out the Beverly Hills Bar Association has different ranges of membership, and each level of membership has a different set of benefits. To those who are joining us, thank you. Those who are members, thank you for being a member. And for those who are not yet members, we hope that you will take a look and check out what we have to offer, what the Beverly Hills Bar Association has to offer, and maybe consider becoming a member. It would be great to have you join us. Couple quick notes, program materials. Program materials were sent out about an hour before the program started. You will also be able to find them in the chat function. With respect to MCLE certificate, that will go out about an hour after the program. Also, a thank you to our sponsors. The taxation section sponsor is the law firm of Hoffman, Salkin, Tasher, Perez, and PC. They have been our stalwart supporters of our taxation section. We greatly appreciate them. So again, thank you to our sponsors. With that, it is my pleasure to now introduce our speakers. And first, I'd like to start off with Stephen Hecht. Stephen Hecht is quite accomplished. All of our speakers are accomplished. Stephen Hecht is a corporate attorney. He has practiced transactional business law for domestic and foreign clients since 1975. He has a long-time experience with financing transactions, business formations and dissolutions, disputes amongst owners of business entities, buying and selling of privately held companies, private placement funding transactions, employment contracts, and more. He has advised on the payroll protection program qualification, compliance, and requirements of the SBA loan documents, and alerting clients to best practice considerations as businesses work through the reopening process. He is assisting clients with meeting the requirements for loan forgiveness. Welcome, Stephen. We have Howard Fisher. Howard Fisher specializes in representing wealthy entrepreneurs and their families. His practice includes tax planning, business and commercial transactions, real estate transactions, trust estate litigation, and tax controversy. He has too many degrees for me to describe at this point, but he is a certified specialist in taxation. And he is a past chair of the California State Bar's taxation section, past president of the Beverly Hills Bar Association, and also is a former president of the Beverly Hills Bar Association taxation section. Welcome, Howard. Michele Weiss is senior counsel at Holtz, Slavett, and Drabkin. She has over 20 years of experience in tax controversy and litigation matters. She's a former senior attorney from the IRS Large and Mid-Sized Business Division. She assists businesses and business owners and investors in resolving their civil and criminal tax matters with federal, state, and local taxing authorities. Michele has expertise in many substantive and procedural tax issues, including tax penalty abatement, offshore disclosure matters, employment tax matters, and conservation easement deductions. She also handles property tax appeals. She has extensive tax court experience. With that, it is my pleasure, and welcome, Michele, So with that, it is my pleasure to turn this over to the speakers and enjoy the program, everyone.
Okay, thank you, Levon. So I just want to give a brief overview of our program. Steve will kick us off and talk about corporate and business issues, and Howard will discuss tax issues, and I'll discuss enforcement issues. And these are all the things you need to think about as you get these loans and ask for forgiveness. There are implications in other areas that you need to be concerned about. It's wonderful to get the loan, but you need to think of everything involved. So Steve, please take over.
Thank you, Levon, and thank you, Michele. And it's a great pleasure to be back with the Beverly Hills Bar Association. I'm always pleased when I'm asked to participate in one of the panel discussions. Uniformly excellent. I watch many of them during the year. So I'm a business attorney, and when I think about PPP loans, I approach it a little differently because I do not have the expertise in tax that Michele and Howard and others have. As we saw last week with the excellent presentation from Bill Norman, he introduced us to some of the intricacies of the second round, how it interrelates with the first round. And that was certainly augmented by Levon's moderation and by Larry Johnson, who is a banker and was able to give us some clarifications and practical advice about how this is working for businesses out in the world. When I approach it, I really do ask myself, what am I worried about? Am I worried too much or am I worried too little? Too little because it's complex and it does, in my view, have an impact on companies and what they are permitted to do. Do I worry too much? Because what is this really about? Well, it was getting much needed money to businesses, and
frankly, I would go the other way. I would get rid of the elephant off your back, pay the $7,500.
The fine points are important, but they were not the key focus. The first round was really chaotic. I was getting phone calls, bankers were, accountants were, clients were calling, they couldn't find a lender. How did the program work? It was delayed rolling out. It was really chaotic. It was a rush. Now it's very different. Businesses have been through the process. Bankers have been through it. The accountants understand it. And the tax lawyers are familiar with it. So it's really adding on to what happened before. So again, as we go through it, I always think, am I worrying too much or too little? And perhaps the attendees will think about that with me and help me out at the end. Next slide, please. So what happens? Well, a client typically will call me and I'll know they've been working on their phones and they did their first loan, they're getting a second loan, or maybe they're applying for forgiveness. And they ask me, is there anything you want me to know about it? Next, please. And what I say to them is, after they ask me, what did you sign? And that's when we looked at the documents the first time around, more familiar with them the second time around, but still you have to look at them because they've been changed. Client says, well, why does it matter? I can't negotiate any of these terms. And the answer is it matters because there are provisions in these documents that a business lawyer would look at and say, oh my gosh, you better be aware of this. Doesn't mean you're not taking the money, but this is how it's going to affect your business, your structure going forward. Next, please. Now, what do we need to know? Well, these borrowings, clients may be a little confused, but they're not from the Treasury. They're borrowed from typically a bank, a lending institution, qualified to make SBA loans. Therefore, next. They're filled with documentation. So clients have filled out and signed a business loan agreement with the lending institution, a promissory note. They've done a disbursement request and an authorization for doing it. They have corporate resolutions to borrow. And crucially, as I'll point out a little bit later, and then Michele will pick up when we talk about audits, we have borrower certifications. Next, please. So what about these loans? Let's talk about them and the documentation. In the basic business loan agreement and the promissory note, they're not going to be much different than what you may have seen with other borrowings, but there are a few things in them that I'll point out in a minute. But basically, they're filled with representations and warranties. These will go to things like eligibility for the borrowing under the specific statute. They'll go to the purposes, perhaps how the money is going to be used. They'll go to the organization of the entity and the authorization for doing the borrowing. This is important because if there are problems later, as we'll see, they're going to come back and look at all of this and see if you were properly organized, if you actually were in good standing, if you'd given the clear authorization to whomever signed your documents. And that's why, from my point of view, I worry that they got it right. They'll be filled with affirmative covenants, lots of affirmative covenants about things that the borrower promises to do, and there'll be negative covenants in them. You'll promise to continue your operations. You won't engage in any financial transaction that's not in your ordinary course. These are common, but again, here we have a particular type of program and they're applicable to it. And then if you've gone to a lender where you already have accounts, they may have a right of set-off in here. And of course, a default on one could be a cross default under another, and perhaps a right to take some money from a different account. Next, please. So here, what have we done? We promised that we're going to maintain in one of these affirmative covenants our same managerial program. If we replace someone, they'll have substantially the same qualifications and experience. Key point, you agree to give written notice to your lender of any change in your executive management, in your executive and management personnel. It's a notice provision. Don't forget to honor your notice provisions, because later, if there's a problem, just like with an insurance policy, there's a period of time that you need to make your claim. You fail to make your claim within that period of time, could result in a denial of coverage. Here, it's not a denial of coverage issue, but it's a proper issue to be brought up if there's a problem. For example, your lender's unhappy with something you've done, and we'll talk about that in a moment. Next slide, please. So here we look at a negative covenant. Again, you agree not to engage in any activity that is substantially different than what you are doing now. You agree not to liquidate. Easy. Merge, not so easy. You might want to change your form of business, transfer, acquire, or consolidate with any other entity. Same point, change your name or dissolve. All the types of things that businesses do commonly, not often, but commonly in the course of their business lives. And here you've agreed not to do that. And as I'll talk about, if there's more time, perhaps at the end, the SBA has issued specific guidelines on when you are permitted to do this and what obligations you have if you do it, and the effect it has on your loan if you do it, and your qualification for a loan. So you need to be aware of it. And another example of what you might do in the normal business life of a company, you might loan money, invest in or advance money or assets to another person, enterprise, or entity. Well, think about it. If you have a closely held corporation, not in the statutory sense, but a few owners of that corporation, or even a single owner, they're often intercompany loans, or the company will loan money, or you'll borrow your money out of your own corporation and give it a note. Are you prohibited from those particular type of transactions that you often engage in? It's an important question. I would say you probably are, and you have to think about your planning when you come up against it. My point being, if you don't examine the documents, you won't know what's in there, you won't know what your promises are, you won't know what your restrictions are, and you may inadvertently make a mistake, and it can come back, unfortunately, on you. Next, please. So in the promissory note, I just want to point out something. I've read through the promissory notes that borrowers sign. At the time you sign that note, there's a particular type of forgiveness program in effect. And you sign the note with the understanding that later you may be able to get forgiveness. That's very important to get that forgiveness. You're out from under the obligations of the note, and you don't have to repay the money, and you don't have to pay the interest on it. The interest on it is small, 1%, but nevertheless, first time around, that made a difference. If you owe it over the 5-year period, even after a 5-year deferral. So what does this tell us in this particular clause? It basically says that if they change the rules later, the new rules apply to you. So careful as you are at the beginning, you really don't know what rules might be in effect when you go for your forgiveness, and therefore you need to be aware of the fact that there's a certain lack of certainty. Next, please. So let's talk about certifications for a minute. You give certifications about what you're doing to your lender, bank. You give them to the government, to the SBA, in order to get the loan. You give them for the loans initially, you give them for the forgiveness afterwards. Next, please. So let's take a look. Embedded in these certifications are provisions about other things where the government is trying to make sure that obligations as to other non-loan related activities may and have been complied with. So you're telling the government in your certification that you're not in arrears on your child support. Believe me, I had no idea till I read it, and I'm not even sure now how important it is. Do I worry too much or worry too little? But you've told them you don't owe child support. You've told them you're current on your taxes. You've told them you've complied with all environmental requirements. So literally they have wrapped into the certification your testifying in a sense that you've done other things. Question is, have you done them? Next slide, please. So here's an example of a certification, and now we have the interaction of the borrower and the bank. Why is it important? Well, the banks have made these loans. They make a certain percentage, a 5% loan fee on them. At the beginning, it was unclear if it was worth all the effort. But now that they've been through it, they know how to do it. And you borrow enough money, 5% is a good fee, and it's definitely worth it to them because they're clamoring in some respects now in round 2 for the business. So just skip down to the last 2 points in red. Lenders are going to have to give back their loan processing fee if the SBA determines the borrower was not eligible to receive the loan. Now, the bank, in effect, has no obligation to do due diligence and determine if the borrower was accurate in all the borrower said to the bank. But nevertheless, if it's not accurate, the lender loses the fee. If the lender loses the fee, where's the lender going to go looking for recovery? Back to its borrower. So there's a place where litigation might ultimately ensue because in the certification, the borrower was not accurate. Next, please. Here we see, and this will be a topic that Michele will talk about when we get to the audits. We now are in round 2. Here's a certification under the second round, which came out in January of 2021, new form of certification. And once again, like the others, you are telling the government basically what's written in red. And if you are incorrect as to any of that, what happens in black is the potential penalty. It's not insubstantial. And I think Michele will have examples where borrowers who got it wrong have a problem. Next, please. So another example, we've got our new loan forgiveness application. And here's the type of thing you say to the government. Next, please. Let me talk about who signs these forms for a moment. The kind of natty little detail that a business lawyer wonders and worries about, and no one else could care. But on all the forms, the signature is by an authorized representative of the borrower. One reason for doing this is, of course, we don't know the form of the borrower. If it's a limited liability company, the authorized representative may be the manager of that company, or it could be a member of the company, or if that company has determined to give corporate type titles, it could be the familiar type of title. If it were a corporation, then presumably you would want the authorized representative to be an officer of the corporation. But it needn't be, it simply says authorized representative. So if you're authorized by an entity to sign it, however that might be done by the entity, presumably you could sign the form. Next, please. And same point. Next, please. So here, who is this authorized representative? Well, you want to make sure that whomever is signing the entity has properly empowered them to sign. In a corporation, you might do that through corporate minutes or a borrowing or action by written consent. Same in a limited liability company. The backup is important. I'll talk about in a moment why that is, but I just want to make one point. Sometimes lawyers want to be helpful or accountants want to be helpful. They're smart enough not to do it, one would presume. Don't sign any of these documents on behalf of your clients. We see a lot of documents often signed by the lawyer. Initial incorporations, a lawyer might sign the articles of incorporation to help out, or one of the forms, or in a company for your annual filings, you'll often find a person in the company, signing the form who's not an officer of the company. Is that wrong? No. But in this case, with these documents, don't do any favors. Next, please. This is a little technical, and let's pass it for a moment. So, question. Is round 2, when you go to apply for your loan, is that going to be an analysis that if you have a round 1 loan, is it debt? It's not yet forgiven. It's on your balance sheet. You owe the money. And therefore, is it going to be harder to qualify for an additional loan as a previous borrower? I don't know the answer to that, but I think it's very likely it's viewed as debt. It's on the books. It is debt. And if it's not forgiven, you owe the money. So how will the banks look at it? How will the underwriting process be affected? I think that's something we have to find out. And perhaps we could have Larry Johnson back. I'll ask him from last week, the banker, see if we can get an answer. Next, please. So if your loan is not completely forgiven, what have you got? You've got a favorable low interest rate loan. Is it transferable in an acquisition transaction? Question. Probably not, because you've agreed already what is the effect of a change of control transaction, which an acquisition would be. No, you've already said in the negative covenants in the borrower's certification, you're not going to engage in any type of that transaction. So in effect, it's not transferable because you can't enter in the transaction in the first place. Of course, you'll get the necessary permission to enter into the transaction, and then possibly the loan can follow along, of course. Next. So finally, what do we worry about even if the loan is forgiven? Well, we have the audit possibility, and we'll learn about that later. In any transaction, there will be due diligence obligations, and whether or not the loan was properly complied with in obtaining it and in the forgiveness process will be very, very important, especially depending on the size of the loan. I think we will start to see in the documentation for acquisitions, reps and warranties, conditions and covenants that will go directly to this point of PPP borrowing. And so therefore, I'm quite sure that in the documentation, and I've already worked on a couple, there will be specific PPP clauses. How they will exactly work out, I don't know, but Lawyers are working on them. And finally, last slide, please. Just before the last slide. So in any event, we know the audits are coming. And what does it offer the opportunity to do from a business lawyer point of view? It gives you a chance to clean up the books. Tell your client, I got to get this in the right shape for you. Your borrowing resolutions need to be properly done because you're telling the bank, these are the people that are authorized and you're permitted to take the loan, and take advantage to clean up your client's books and records, because they probably don't want you to do this before because they don't want to spend the money, but you may get a little bit of extra opportunity to put them in the right place. Next slide, please. Let's go to the next slide. Go back one slide. I've got another moment. I'll go quickly. Another point, when we do some of the calculations under the new borrowing round, we have a question of whether someone's an independent contractor or an employee, because there's some counting that takes place that is different. In California particularly, we have Dynamex and AB5. Dynamex ABC test, it's now retroactive, as the Supreme Court just decided. And therefore, you have to keep that in mind, that if you call someone an independent contractor, in California, they may really be an employee. And if that's the case, how does that affect the counting you've done to qualify for PPP and the calculations there, when in effect under California law, those persons were not independent contractors? Next slide, please. So thank you for letting me go on with this. Go back one, please. And let me just conclude by saying that I would suggest you wash your hands and then do your applications, your certifications, and your forms very carefully. I would say you wear a mask to muffle the screams of tedium from doing this, because it really is tedious. And finally, I'd say keep a safe distance, and it'll keep you away from the auditors. So thank you for letting me speak to you again, and I appreciate the opportunity and hope it's been of some use to you.
Terrific. Thanks so much, Steve. Great presentation. Little tips like when you do a sale transaction or merger transaction, to have a PPP loan clause, very important stuff. Kind of things you're not going to find in any of the form books. Great tip. Well, I get the pleasure of talking about probably one of the most miserable subjects on earth, and that's taxation. And let alone taxation, but taxation related to what's going on with the various relief programs. To start with, back in March of 2020, there were actually 4 different bills or acts that were passed. They're set forth in the outline. Although we're focusing on the payroll protection plan, some of the others had specific tax provisions in them as well. So you start with 4 items. Then we come to December, and we have the Consolidated Appropriations Act, and that brought us a whole host of more provisions. And so by now we have almost 7 different laws that we need to look at. There are proposed regulations, interim final regulations, that's a nice oxymoron. You have frequently asked questions posted on various government websites. At point 5, next page, there's a description or a limitation on the IRS's webpage that their FQAs are actually out of, they're not current anymore because of changes that have already been made. So, it's very tough to try and figure this all out at one time. One of the most important changes that has come about with the December Act, if we could go to the next page, please, is deductibility of the PPP loans. This was, you would tend to think that if you're going to have a program that you're trying to encourage employers to retain employees, that they would figure out a few key things about the income tax rules. And there was very little that was done in the original legislation. Normally, when you borrow money and receive it, it's not taxable because there's an offsetting obligation to pay it back. If the loan is forgiven, the Internal Revenue Code provides that's the type of income. You have debt that's being forgiven, and you have income to the amount equal to the amount of the forgiven loan. And if the PPP loan had very specific requirements, it had to be used for things like interest on a mortgage, rent, utilities, healthcare expenses, and employee wages, payroll expenses, virtually all of which would be deductible. So in the absence of any tax discussion, what you probably would have had is no income liability on receiving the loan. When the loan's forgiven, you would have had income tax liability in the amount of forgiven, and you get a deduction for the expenses in the ordinary course. So if you paid back principal on a mortgage, there'd be no deduction, but if you paid back interest on a mortgage, there'd be a deduction. Well, the IRS followed this all up and issued a couple of announcements saying that no, the forgiveness of the loan is not income, but you can't deduct the expenses. Congress chimed in and said, no, that wasn't our intent. And the IRS issued a revenue ruling saying, we don't care what your intent was. We're still going to treat it as non-deductible. Well, the December Act clarified all that and made it real clear that when you have forgiveness of debt on a PPP loan, there is no taxable income generated, and you get to double dip because you'll get to deduct the related expenses. Very unusual, but it's another form of a tax incentive. It's not really talked about. That actually helps the borrower. So the major change. Of course, we all live in California. And California, nothing is ever easy and nothing's ever simple. California does not have automatic conformity. When there's a change in federal law, there's no change in state law. Well, California in September did a conformity bill which said that forgiveness of the loan, a PPP loan, will not generate taxable income. So to that extent, it's consistent with federal law. But there's been no talk and no legislation yet in California that you can deduct the expenses that are incurred, which is contrary to what the federal law now is. So what are we going to do? We have estimated tax payments, for example, that may be due. I personally, the opinion, and I may be a minority of one, that you should be able to deduct the expenses even if there's no legislation, because there are ordinary and necessary expenses, for example, and they would qualify as such as a 162 deduction. If anybody has something, comment to the contrary, let me know. Next is the $600, soon to be more, stimulus check that everyone gets. Well, not everybody gets. And it's not actually a stimulus check. It's an advance refund of a refundable credit, even though you haven't filed a tax return yet. As Albert Einstein said, the hardest thing to understand in the world is income tax. And he said that for good reason. This is just a great example. So there's a credit of $600 per taxpayer and $600 per qualifying child. And this is based on the 2019 tax returns. Ooh, what if you have a child born after the return? And what if you had so little income that you didn't have to file a return? The IRS has a portal that you go to and you provide the information, and hopefully that will work. The credit is unfortunately phased out starting at about 70,000, 75,000 modified HEI for individuals, 150 for married couples. So by the time you get to, 200 plus thousand in income, you're going to not be able to qualify for the $600. They also limited the number of individuals or the types of people who can claim and get the benefit. You needed a social security number. Well, what happens if mom and dad are not documented? The child is born here and has a social security number. They should be able to qualify. And that's been a problem. Non-resident aliens are not entitled. So you may live here part of the year, but if you live outside of the country, doesn't matter. You're not going to be able to qualify unless you are a resident alien. And resident alien is a tax term. It's defined, and it has nothing to do with immigration status. So everybody who's here living in this country should be able to qualify. Somebody who's a dependent of another person does not separately get a benefit. So my 17-year-old kid who's on my tax return, I get the check, they don't. And of course, the state trust and other juridical entities do not qualify. And the credit's going to be based on the 2020 tax return. So you'll find that the tax returns are going to become a little bit more complex. If you end up getting a check and it exceeds what you're entitled to, you're going to be fortunate in that you're not going to have to pay it back. Government doesn't want to have to deal with trying to figure this all out. Kindly go to the next slide. And another bit of good news, let's go to the next slide, is these payments are not subject to administrative offsets for past due federal tax, for state claims, for alimony, child support, or other types of things. So people should be getting these checks free of any encumbrances, and they're supposedly exempt from bank garnishment and levy, private debt collectors. The point is going to be very difficult when it comes to tracing, because most of these funds may get dispersed pretty quickly, and then someone later on is going to try and claim that they have some exemption. The Payroll Credit Act.
Howard, one second. And I think this could be for Howard and Steve, that we have a question in the chat box. And it says, what happens now when you as owner employee operate through a C Corp and that deduction for the PPP loan expenses creates retained earnings that cannot be paid out of compensation? Do you think the IRS will eventually deal with this and allow a tax-free dividend or something to that effect?
I don't think so. I think they've already given you enough by saying you could get a deduction even though you don't have income. So I don't think they're going to make an exemption for that. And it's going to apply to a fairly small number of circumstances. Steve?
I agree with you, Howard. I agree.
And the comment comes back, says, well, then you're never going to be able to get money out tax-free. And the answer is, yep. But you're probably no worse off than you would have been if you had a forgiven loan and you could get the deduction straight away and not get the double dip. So that's one of the reasons I just don't think they're going to be very helpful. The March Act created a payroll credit for paying out for employees who had to take medical leave to cover themselves or to help an immediate family member. And originally, it applied to employers of less than 500. It's now been expanded to all employers, including those of more than 500. There doesn't seem to be any attribution rules on this. So it could apply to obviously very big companies. The credit requires you to provide up to 80 hours of paid family, medical, and sick leave at full pay to employees to get the credit. And then you're supposed to provide 10 additional weeks at 2/3 pay. So it's very helpful in terms of retaining good employees. I can't speak to the labor issues of whether or not, the circumstances you could terminate somebody if they can't provide services, especially if they're a critical employee. But from a tax perspective, it's going to be helpful. The employee retention credit is one of the probably biggest benefits that you don't hear a lot of people talking about. Because unlike PPP loans where you can't get a coverage for employees of more than 100,000, for example, the employee retention credit doesn't have a similar limit. Although PPP loans were limited to less than 500 employees, the employee retention credit has no limit, so it applies to the biggest companies. And this is where the airlines have gotten, for example, a bit of a break. The December legislation did make several important changes. One, it's going to extend the credit through July of this year, as where before it would have ended at year's end. It added eligible employers, credit unions, colleges and universities, healthcare providers. So it expanded the eligible group. Like I said, it increased the numbers of people who will be eligible for the credit. And the credit increased from 50 to 70% of qualified wages. So it's the government's paying a substantial chunk of the cost of retaining employees. What's a qualified wage? You start with the number of employees and you base that as to 2019, and that becomes your cap. And as Steve talked about earlier, what do you do in California when you have AB5 and you have to reclassify workers? If you have less than 100 employees, then it's any wages, doesn't matter. If you have more than 100 employees, then your business has to be impacted by a governmental order, and those are, for example, a lockdown. You can't operate your restaurant, so you're under a government order. Or you have experienced a significant decline in gross receipts. So you may be a business that was allowed to stay open, but your income is way off. Your department stores, your retails. Although interestingly, vehicle sales has seen an increase in the last year. Also, there has to be a decrease in gross receipts from the previous year, and that used to be a 50% decrease. It's been changed to a 20% decrease, so it makes it much more attractive. And the limit was originally $10,000 per employee. It's now been increased to $40,000 because it's $10,000 a quarter. So it's become much, much more advantageous to make use of. And I think you'll find not only will this help many of your clients, it may also apply to some law firms, especially firms that, although business may not have really dropped, but if you're like a PI firm and you've had a big dip in cash flow, for example, because you went through a period where we weren't doing Zoom settlements and there was no litigation, they may find this very helpful for them. And you can now take emergency loans. Originally, you couldn't take emergency loans. Those are the big key changes that were part of the legislation. There's all sorts of tiny little things, some more interesting than others. I'll run through them. If you don't itemize and you're married, you can claim up to $600 and above the line charitable deductions for cash, and there's no adjusted gross income limitation. It used to be 50% limitation. That's been suspended, and that goes now for 20 and 21. The medical expense deduction floor, I wish Congress would just kind of make up their mind. It used to be you can only deduct medical expenses above 7.5% adjusted gross income if you were 65. Then if you were over 65, rather, it went to 10. It was 10% for below 65. Sorry. Then Congress changed that for 2019 and 2020, and everybody had 7.5%. And so it was supposed to jump back to 7.5 only for the over 65. Now it's going to stay at 7.5. Isn't that wonderful? And try and figure all this out. It's a lot of people just say it's not worth it. Qualified indebtedness on principal residence. Well, you lose your house, you have forgiveness of indebtedness, of course. And there was an exemption originally for $2 million in forgiven debt on a joint return through the end of the year. Well, that's been replaced with now $750,000, but it's been extended out to 2025. They realize that a lot of people aren't going to be losing their home necessarily in the first 6 or 8 months of what's going on, but may in the next year or two. And what's qualified principal residence debt? It basically had to be used to purchase the house, refinance the house, or to substantially improve it. It doesn't really apply to HELOCs. A tiny nod to the restaurant industry. We're at 0.35, so you could skip to page 7. 2 martini lunches are temporarily back. For a long time, you've been able to deduct only 50% of your meal expenses. Now it's back to 100% of expenses incurred for food or beverage provided by a restaurant. Now, what about in-house catering? What about meals with, if you have an event at a hotel for your clients? It's not quite clear how those expenses are going to be applied. Originally, the Jobs Cut Act also cut out entertainment expense. That was not changed, unfortunately, by the December Act, and that's still the rule. There was a minor
Howard?
Yeah.
There's a comment in the chat box, if you could take a look at it.
Where is it?
It says, if I understood the prior question correctly, I would say that there would not be any increase to retained earnings as a result of the forgiven PPP loan. In essence, the deduction of the otherwise disallowed expenses that were covered by the PPP proceeds would, in essence, offset the increase to retained earnings from the forgiveness. The net would be zero effect to retained earnings.
Might be. Good suggestion from you, Stills. Thank you, you. Back to page 7 of the outline. Controlled foreign corporations were allowed to exclude certain type of income from what's called subpart F income, which is what flows out to U.S. shareholders. And so that's the exclusion for rents, royalties, and received from related CFC has been carried on through 2025. It's been extended 5 years. The child care credit and earned income credits have been extended as well. There's been some adjustments in the carryover rules for flex spending plans. This was a real Christmas tree of legislation when you look at paragraph 38, next page, and you see that there's a exclusion from income for health care insurance credits received from PBGC for people over 55 and less than 64 years old. How many people is this going to cover? It's a shame when we have legislation passed at the last minute, nobody reads it, nobody figures out what it really means. We have no discussion of policy, what should be done, what should be covered. So some people's special interests, like 38, get taken care of, and a lot of people get left behind, unfortunately. There was an employer program which would allow employers to pay up to $5,250 of a employee's student loan, and it would not be income to the employee. It would be deductible to the employer. That was set to expire at the end of 2020. It's been extended 5 years. Very positive provision. Under the December Act, the IRS was authorized to waive the issuance of some of Form 1099-Cs, for example, cancellation of debt. And a few days ago, the IRS issued an announcement, I think it was on the 19th, saying that lenders wouldn't have to be issuing those. There's extension of the energy credits and the empowerment zones. And those are some of the highlights. California, put an extension or moratorium originally on paying over some types of taxes. Those are all set to expire, and I've heard no talk about extending them. Some cities have some special provisions. For example, Beverly Hills has a transit and occupancy tax, and they've allowed the hotels to retain that and not pay it over and keep it for another year. Not that there was much tax to pay in the last couple of quarters. So there's tax issues up and down, federal, state, and local. It's going to get probably a little better. Some things will be ameliorated in the next bill, which we're certainly going to be seeing under President Biden and the Democratic Congress. Thank you.
Okay, thank you, Howard. That was a wonderful presentation, lots of information, and really great resource to have this outline in our materials. All right, so I'm going to be talking about loan enforcement issues under the PPP loans, and we're going to, the next 2 pages, and Alex, you can scroll through them pretty quickly. I included a copy of the application for, I think it's the first draw of round 2. And unfortunately, it's not clear on the screen, but if you look at it, there are so many different things that that an applicant has to fill out, all these different elements of information of how many employees they have and what the payroll was and how they counted it. And then on the second page are all these certifications that an applicant has to sign off on about, and that Steve mentioned earlier, about all these different things that they're compliant with. And one of the big issues is whether they needed to take the loan. Back in round 1, there were some applicants who realized afterwards that maybe they really didn't need it and they gave the money back, and there was a safe harbor. If you return the money by some point in May, it was as if you never took out the loan. I don't think I saw a safe harbor for this round, but anyway, there's lots of information in there and lots of places that people can get tripped up on their applications. In going through all this, there are all different types of ways that you can make a mistake. And there's a very big concern about the amount of fraud and potential criminal activity that was involved in people applying or businesses applying for these PPP loans, partly because, especially the first round, it was all done in such a rush and a flurry and nobody knew what was going on. And, when you dangle some free money in front of people, well, they want to come in and claim it. And so some people went to pretty far extremes. There were a few cases, there were 2 cases actually, where people were found to have used the proceeds to buy Lamborghinis, not related to their business. And another person who went to Vegas and went gambling. And if you go on the IRS website and you Google, type into the search PPP loan fraud, you'll see pages and pages of cases of people who took millions and millions of dollars in loans, and it was all fraudulent. And some of the things they did, they fabricated businesses that really didn't exist as of February 15th, 2020, which is critical because that means you were in business before the pandemic hit. There were falsifications of the different documents that were used, misrepresentations of the number of employees, and all different types of things. And so in the fraud criminal area, what you're looking at is really people being intentional. This is not accidental foot faults. This is not, oh, my accountant calculated that I had 50 employees, but I really only had 45. I mean, this is people really just taking money that they weren't allowed to. And the SBA is actually committed to auditing all PPP loans of $2 million or more. So if you received a loan of $2 million or more, you can be pretty rest assured that the SBA is going to audit you. That does not mean that people who receive less than that are off the hook. It just means that there won't be as much of a push. I mean, there are limited resources to doing these audits, and the SBA is trying to use its resources where it can get, for example, the most bang for the buck. You need to be concerned about this because there has been such a concern about fraud that you really need to worry. Okay, so please go to the next slide. So there are different penalties. So what happens, right? So we know there's criminal liability for PPP loan fraud. You're lying on an application, misuse of personal funds, misstatement on a loan application submitted to an insured financial institution or a federal agency becomes a federal crime. There's also an issue with a False Claims Act liability for knowingly submitting or causing another to submit a false claim to the U.S. There are some civil penalties per claim, and then multiples of the government's damages. Also, individuals can bring actions under the False Claims Act against people who were inappropriate in how they obtained the loans, and they get a little portion of it. And then, of course, there are tax-related penalties as well. Do you really have income? You can have delinquency penalties, negligence penalties, fraud penalties, up to 75% of the amount of tax that's due. And then, of course, criminal liability for filing a false return or evading or avoiding income tax. So these are all of the things that can be, all the penalties that can occur to someone who's made these mistakes. So and this is a sort of a recap. There are different foot faults. So someone might say, well, okay, I'm not fraudulently doing anything. I'm not willfully trying to make a mistake. I didn't fabricate my business. I was somewhat diligent in how I came up with these computations. I use competent accountants and so on. But the application is complicated. And the critical thing is that it's being signed under penalties of perjury. And this is something that you really need to take seriously, because that's where the penalties can come into play. And what you're saying is you're attesting to the fact that this is correct. And so there are certain certifications that, you need to worry about. And the biggest one is the current economic uncertainty makes the loan request necessary to support the ongoing operations of the applicant. Did it? Is that really true? Was your business really having a problem, or did you just see a possibility for some free money and you applied for it? And so the loan proceeds need to be used for a proper business purpose and so on. And these are the things that you need to worry about. Maybe you think that you're out of the loop because you weren't purposely trying to do it, but how careful were you in going about your loan application? And also that applies for the loan forgiveness application. So this one aspect of whether or not you really needed the loan, the SBA has FAQs to help people with their loan application and their loan forgiveness. And the only real safe harbor for audits in all of the FAQs is this FAQ 46, which says that there's a presumption that if the loan was for less than $2 million, that the borrower actually needed the loan proceeds. And the reason why is the thought is that this business, which has less funds, probably really needed the funds. And then for loans of $2 million or more, then you have the usual issues of what could happen in the course of an audit. But that is the one and only safe harbor with respect to this whole process. And now I'm going to talk about the different agencies that are possibly pursuing these fraud cases, because there's a really big push to try to find these people. Okay, so there are multiple federal agencies who are coordinating their efforts. There's the SBA, the FBI, the DOJ, the SEC, and the IRS. So step back for a minute and think about this. When you have this many agencies pursuing people for possibly having foot faults or fraudulent loan applications and loan forgiveness applications, there's a very good chance that they're gonna find you. That's a lot of resources going into these types of audits and investigations. So first, I'm going to talk about the SBA and the FBI. So as I talked about, the SBA is committed to auditing loans $2 million or more. The CARES Act created a special office, the Special Inspector General for Pandemic Recovery, to focus on auditing PPP loans and can refer these cases to the DOJ. And if the loan is less than $2 million, there's still a risk, but if it's $2 million or more, you need to get ready. The FBI is also involved. They investigate all forms of federal fraud, and they're specifically targeting individuals and companies that have either, once again, submitted false information, used PPP loans for unlawful purposes, or submitted fraudulent certification for loan forgiveness. So it's the same things over and over again of businesses, in somewhat of financial distress, that they're signing these documents, they're signing them quickly, and were there, foot faults that they really should have had better due diligence and not made those mistakes. So the DOJ and the SEC are also involved in this. The SEC dealing more with if there's a public company that applied for a PPP loan. It's probably not as prevalent since those companies tend to be much larger, but they are looking into those cases. Of course, the Department of Justice, they are targeting and prosecuting suspected fraudsters. They filed their first complaint in May. And here are some of the accusations: submitting multiple PPP loan applications to multiple lenders. And, some people just did that. They weren't thinking, and they ended up with more than one loan. That's really a problem. If that happened, you really need to think about how to deal with it. Voluntarily coming forward in any situation that could involve fraud or criminal activity is always a better plan than waiting for them to find you. And you might want to think about consulting with an attorney who can help you about that. Creating fictitious companies or payroll data to support PPP loan applications, falsely claiming to own businesses to obtain and divert funds, using PP loan proceeds for personal expenses. So the first one is something that possibly even someone who wasn't looking to do something fraudulent, wasn't so intentional, but it just happens in the flurry of everything. Multiple applications are being submitted, and what did you do when perhaps there was a misstep in how you received your funds? And the IRS is also involved in this. Now, the IRS at the end of the day is involved in the tax result, right? So it's looking at the impact on unreported income and tax liabilities. There could be multiple penalties involved. It can evolve into findings of federal tax evasion and tax fraud, criminal liability. The IRS recently set up a fraud enforcement office. It was just established in early March, just before the pandemic hit, but they definitely are taking on the PPP loan issue as something they're looking into. There was also a couple months later in the spring, the IRS established a National Fraud Council to support the Fraud Enforcement Office. And so they are beefing up their operations in that division. And the IRS also has been using an increased amount of data analytics. They're getting up to speed with technology. and they're able to find you. People will come to my office and they'll say, how did they find me? How do they know? Well, they do, there's so much information involved. And when you have these 5 agencies all working together and sharing information and refer back and forth, if there's a problem, there's a much better chance that it's going to be located because of all the resources that are being put into this. It's the full brunt of all these federal agencies trying to find people who abuse the system when other people were in so much financial distress. So we come to the question of what do you do? What do you do? What happens? Well, one thing that's really important, and this is probably an obvious one, is to maintain your files, organize your resources, get your documents together, have a file ready to go. It's actually specifically in the regulations. It's not just a policy, it's in the regulations that recipients must maintain files for 6 years. What this means is you can think about that if an audit happens 5 years from now, there's no excuse to say, oh, the records are too old, I don't have them. Do it now, get it ready, have the file ready to go, and just make sure that you have it in a place that you can find it. Another issue is to be proactive and diligent. You should review your application, do a compliance check, meet up with your attorney, and try to figure out, did I do this correctly? Was there a problem? When you start looking into the loan forgiveness application, this is the perfect opportunity for an internal review and compliance check. And at that point, think about it. If you had mistakes and foot faults that can really lead to problems in the loan application process, think about whether you want to apply for loan forgiveness. Do you really want to do that? This is another opportunity of submitting yet another document signed under penalties of perjury to a federal agency requesting government funds. Is this a good idea? Is there a problem? And if it's not something you can readily fix, maybe it's time to step back. You're not required to ask for loan forgiveness. 1% interest rate is a really nice low interest rate on the loan, and maybe you can stop the problem from rolling along by just thinking about whether or not you want to apply for loan forgiveness. Analyze the risk of exposure that you have when there are multiple agencies involved in investigations and auditing and liability. Think of how much money is involved if I don't apply for loan forgiveness. Will that help me in my audit risk? What's going to happen here? And as Howard was saying, the law is constantly changing, and taxpayers and loan recipients, borrowers are expected to keep on top of it. You need to keep current with legal changes and updates. If you're not able to do it yourself, make sure that you have an attorney involved who can keep you updated. If you need to change something, if suddenly there's another document you need or whatever is going on, you are responsible. You cannot say the law changed afterwards. That's just not going to be an excuse. And if you receive a notice from a federal agency, don't put it in the garbage. Seek advice of counsel immediately. I cannot tell you how many people, and this goes for any type of notice, I cannot tell you how many clients come to my office and the problem that they had, which was a small problem, became a big problem because they thought if they just didn't read a notice or if they put it aside, it would go away. It's not going to go away if you're not compliant and cooperative. It will only make the problem worse for you. And cooperation is really key. It really helps when you have a difficult situation. If you could be shown to be somewhat cooperative and compliant with the federal agency who's investigating you, it does help. It really can help you in the long run. It's kind of like getting, kind of brownie points or something, just because the hardest thing is when they know that someone hasn't done something correctly. And then one of the worst notes that could be in the taxpayer's file is they failed to cooperate, they failed to respond. That's not going to help you. So in a nutshell, and someone asked about being proactive, I think being proactive is key. I think the time for either applying for round 2 or loan forgiveness is a good moment to do an internal compliance check and make sure, are you inviting the government back to put its nose back into your business potentially once again, when perhaps maybe things aren't so clean, or they're complicated, or they were done incorrectly. And these are all things that you need to think about and consider when you're going through the process of both applying for round 2 and also for your loan forgiveness application. And I think we have some questions in the chat. Steve, there's a question here. It says client borrowed $3.5 million based on its payroll, but client arguably did not have good reason to believe that its revenue would decrease by that amount. And in fact, the revenue did not decrease. Is there anything new about the initial necessity representation? Also, can client pay out excess cash flow as dividend to its shareholders prior to obtaining loan forgiveness? So this is from Gary Edelstone. Gary Edelstone, I am going to direct you to that FAQ 46 because that does address one of your questions. And then the second question, can client pay out excess cash flow as dividend to its 2 shareholders prior to obtaining loan forgiveness? Does anyone know the answer to that? Do we know this?
I think Gary added on, Michele.
Oh, I mean to say distribute dividends after getting loan forgiveness. Okay. All right. So Gary, I'm thinking, are you concerned that this was for that they were getting the loan forgiven and somehow they were using it for personal expenses? Is that what you're getting at? I'm not really sure what the question is here.
What the worry is.
Yeah. What is is that the concern that somehow it was going into the pockets of the shareholders? Okay, Gary's not, well, obviously he can't respond. I mean, you just have to be really good at tracing what funds you got and what you used it for and when. I would think that that's I mean, Steve or Howard, do you have anything else to add to that?
No.
Okay. All right. Oh, how do you distribute surplus from a C Corp? I'm wondering why this would be different than in any other situation. I mean, you distribute it, I don't know, through dividends, taxable dividends, I would think. Anyone else have an opinion on that?
Obviously, salary.
Yeah.
Look to pay back outstanding loans, shareholder loans.
I mean, and not anything different than in any other circumstance, I don't think.
The combination of the PPP forgiveness, allowed deductibility, effectively is a double dip.
Right.
And so, what do you want, a triple dip?
Right. Here it is. Concern that the funds were spent for proper purposes, but the money is fungible and there are equivalent funds left in the company because net income did not drop. Well, so first of all, regarding the certification, if you look at that FAQ 46, if your loan was lower, then you have a presumption, first of all. Second of all, you need to track what you spent the money on and show, you just need really good books and records. It's not simple, but you need to really make sure that you can show what the money was used for.
I mean, some people talk about heavy duty tracing, put the PPP loan into a separate bank account and then use that to make payroll expense. You heard things like that earlier. Good advice.
Yes. Yeah, I think people have tried to do that just to make it really obvious what the money was being used for. And
if you didn't, for example, I didn't, but it's real clear that, we make payroll and here's the payroll expenses and here's the 941s. And it's real easy to trace. And yes, money is fungible, but it didn't have to be those specific dollars used for very specific purposes. You just had to expend funds on that during the qualifying period.
Okay, and then it says here, it's not about triple dipping, it's about being treated the same as a sole proprietor, which a sole employee of a corp will not be.
Well, they never are.
Yeah.
And that's why, most people have stopped using C corporations long ago. And we now see pretty much LLCs. And of course, C corporations never really protected you from a lot of liability when you were the sole shareholder, sole officer, because you were in charge of most everything. And being in charge, you'd always have personal liability.
Yeah, I mean, I don't think it's any different than in any other situation like this. So, and then just as a wrap up and just, a note of caution to everybody, and I tell this to people all the time, you really need to think about twice when you sign stuff. And I think Steve was trying to discuss this, was discussing this in the beginning also. You're signing things, you're signing them under penalties of perjury. Just don't go signing stuff. You should not be signing. If you are not sure of the information going into that loan application, do not sign it. Double check it. And if it's wrong, but you did due diligence and you can show that you really tried to figure out the right answer, you're not going to be, no one's going to fault you for that in terms of a massive penalty. It's just like in any other situation. I mean, signing things under penalties, and you have things that are going to multiple agencies, and then there are people who submitted loan applications and then changed their tax returns, which they submitted with their loan application. Did they not think that the SBA could just so very easily find out what the information is from the IRS? Just really obvious things like that. Just be careful. That's all I can say.
I'd like to say I began my presentation with the question, as a business lawyer, do I worry too much or do I worry too little? You're listening to Howard explain the complexities of everything quite well, and Michele point out the problems with getting wrong, especially your certification. I once again am convinced that I worry too little, and I am not worried too much. And as attorneys who have business clients, I think the message to them is you need to worry.
And word of caution, when you get that knock on the door by a government representative, don't make a false statement or even an inaccurate statement. Title 18 USC 101, any false statement made in the course of an investigation can lead to a felony. And that's what Roger Stone was in for, and Flynn, General Flynn was in for, and a number of high-profile people over the years have gone to jail for saying, who, me? I don't remember what I was doing, or I didn't do that. And a lot of times when the government asks you a question, they already know the answer.
Yes, that's actually accurate. They already have the information, and you're just they're just waiting for you to make a mistake, and then they can, I mean, sometimes yes, sometimes no. You don't. Sometimes they really and truly are seeking information, and sometimes they're just holding the information, and you can just trip up. And because you don't know which is which, you need to be really careful, and again, probably seek counsel in these situations. Because the penalties can become onerous, both financially and also with your freedom. So,
the good news is they're not going. They may audit a lot of people. I'm not sure they're going to be able to do a lot of deep dives.
No, there's no way. There's no way. But you never know if you're going to be the one. So.
And then there's likely to be tens of thousands of people who've goofed up, and they're not going to be prosecuting everybody.
No. They can't. But what they like to do, I mean, is pick out a few extreme examples, and those are the cases that very quickly produced indictments and convictions, so that people, it's really done for a splash and show, so people can worry. It's very hard. I mean, I could tell you, being on the other side, it's really hard to put together a fraud case or a criminal case. It takes a lot of work. And it's not a simple thing. And, they're trying to do it quickly just to make a statement about it. And there's only so much resources that, the government has to put into these things. But, just
That's
do
what
a
they like.
compliance. Yeah, just do a compliance check and minimize your, figure it out.
Let them bother somebody else.
Yes. All right. Well, I want to thank everybody for attending. I hope you got something out of it. Thank you, Howard. Thank you, Steve. Enjoyed presenting with you. I'm the chair of the tax section, and on behalf of the tax section, I want to thank everyone for attending. Have a great weekend, everybody, and take care. Bye-bye.